Hey, members, I'd like to welcome everybody present here and online to the meeting of OHA's Committee on Resource Management. It is Wednesday, April 17th, 2024, and it is 1:30 p.m. I'm officially calling this meeting to order. Members present is Trustee Galutaria, Trustee Souza, Trustee Akaka, Trustee Aquina, Trustee Ahuna, Trustee Hulu Lindsay, and Trustee Ahuna, Trustee Trask, and myself, giving us the quorum. Also supporting us on this virtual meeting, the support staff is Karina Kina and Melissa Winahan, and joining us also is our Pohana, and there's Stacy Ferreira. And at this time, I'd like to turn this over to Stacy to introduce the other staff on the virtual meeting. Stacy.
Mahalo, Chair and trustees. Joining you today for the RM meeting, we have our Endowment Director, Ryan Lee, in the room. We also have Interim Corporation Counsel Everett Ota, also sitting in the boardroom. We also have Interim Senior Legal Counsel Nichi Ozawa, and IT Systems Engineer and Administrator Kevin Chalk, IT Systems Engineer and Administrator Kelsey Wade. Mahalo.
Thank you, Stacy. Moving on, members, my understanding is there is no one signed up for oral testimony.
That is correct. Zero registrants to testify on any issue today. Thank you.
Okay. So we'll move on to the approval of the committee minutes of March 6, 2024. Is there anyone signed up to testify on the minutes?
No one's
testifying. With that, can I get a motion or to approve the minutes? It's been moved by Trustee Aquina. Is there a second? Seconded by Trustee Souza. Members, does anybody have any changes to the committee minutes of March 6th? Okay, if no one does, can I get a roll call vote for their approval?
Trustee Ahuna.
Aye.
Trustee Akaka. Aye. Can someone turn on my camera? Aye. Hello, Trustee Aquina.
Aye.
Trustee Alapa is currently not here. Trustee Galutaria.
Aye.
Trustee Lindsay.
Aye.
Mahalo. Trustee Souza.
Aye.
Trustee Trask.
Aye.
Chair Waihe'e.
Yes.
8 yes votes.
So the minutes are approved. As we have no unfinished business, we shall move on to new business consequence capital management introduction. Is there any oral testimony on this new business item?
There is no testimony.
Okay, with that, I will turn this over to our CIO external, Vijay Chatterjee. Vijay, you can take the reins of this introduction.
Hello, Mike Heiko. Thank you very much, Chair. It's very nice to be here again. Thank you, trustees, staff, and distinguished guests. As you know, my name is Vijay Chatterjee. I'm with Consequent Capital Management, and we are the board consultant. So we are the advisor to the board on the investment portfolio and activities, and work closely with the board and staff and others. Today, our presentation has been distributed, and we'll go through sort of the normal routine in terms of the format. But then we also have some recommendations in terms of investment beliefs to adopt and add to your investment policy statement. So we're moving a little bit from into solution space from problem space, if you remember the language we've been using. And it's the intention also to be coming back with other sort of policy recommendations in the next few meetings. And so we can talk more about that, but you'll expect to preview suggested and recommended changes or additions to your policy documents and have time to deliberate and provide feedback, and we'll make changes and revisions as we've tried to do with the investment beliefs this time around. So we'll spend a little time on that. And then we're also going to have some of your investment managers present for the remainder of the session with the investment portfolio. So if we go to the PowerPoint presentation, you'll see the meeting agenda that I've kind of outlined for you there. There's in this document some background information about Consequent Capital, and I believe several of my colleagues are on the online, if not in the speaker feed, then in the public feed. So they are, I am also joined by Ken Simon, the CEO, and you remember Jerry Flintoff, our head of private and alternative markets. So I'm going to give a little update on the activities. We'll talk about the investment beliefs and presentations. The glossary or the appendix in the back is the same document that you saw previously in terms of prompts and to help you think about what are investment beliefs and how you can go about forming them. And then our usual glossary of terms. And then in separate from this presentation, we have a memo that recommends the investment beliefs to the board's consideration. And also we have presentations from PIMCO and State Street Global Advisors to round out the session. So if we move to page 4, I'll just review a little bit in terms of activity. So in terms of last time, we did an education session on the importance of investment beliefs and where they fit into investment policy statement, how other institutional investors articulate and then use investment beliefs to their advantage and for communication and education and continuity between leadership over time. And then, as I mentioned, we'll also hear from, this time, the managers. Coming up in terms of the next several RMC meetings, you see we have additional service providers and managers presenting. You'll note that Makita Investment Group has been added to the May 22nd meeting. Makita is a traditional independent sort of investment consultant, not a board consultant, but an investment manager consultant. So they currently work with groups like the Hawaii ERS and the Hawaii EUTF. And so they'll talk about sort of how they do their work, and not unlike what other outside speakers have come in to help you understand how it is to work with different types of entities in the marketplace. And they're just one example of that. Also, you'll note at the June 26th meeting, although I've made that tentative, we've invited someone from the Wyoming Permanent Mineral Trust Fund to come and present and talk about how that kind of state sovereign wealth fund, if you will, organizes itself to meet its mission and objectives. And that's potentially a type of investment asset owner that's has some common characteristics with OHA. And so a way to identify and expand your network and learn from your peers in the marketplace that are most aligned in terms of organizational structure and general objectives. So that's coming up in the next several months. The next slide here on page 5 is a reiteration of investment beliefs, investment belief statements. You've seen this slide before, and it talks about, differentiates how it's not necessarily a mission statement. It's not an investment policy statement, though it can be included in the investment policy statement. And then there's several examples from different groups like Harvard and CalSTRS in terms of, and within the Harvard document, there are many more entities that are given as an example of how investment beliefs are utilized by asset owners in the marketplace to better oversee and manage their investment portfolios. So with that, and again, this appendix here is investment belief prompts. So we went over that previously, and that's been available for the trustees to review. What I'd like to do then is to switch over to the memo, which is, I think it's in a Word document if it wasn't made into a PDF, dated April 17th, and investment beliefs to be adopted into the investment policy statement. So in this memo, we are recommending that the Resource Management Committee should recommend the adoption of the investment beliefs stated in the memorandum and also distributed via email and separate document, pending any final edits or modifications as approved by the Office of Hawaiian Affairs trustees. The investment beliefs can be incorporated at the beginning of Section 2 of the OHA investment policy statement that's dated 2021. And so what follows is a discussion about investment beliefs and how they're used. Again, looking at groups like CalSTRS and the Harvard study. But then if we scroll down a little further to the bottom of page 2, or the second half of page 2, where the section that begins proposed investment beliefs, the language and the discussion, the words here, the text can be adopted directly into your investment policy statement. Again, kind of at the beginning of part 2, section 2. So the language here, I'm not going to focus so much on, but I'll go right to these investment beliefs and kind of highlight them for the trustees. What we're proposing are 8 investment beliefs, which cover different aspects of the marketplace and how they operate. And if you recall from some of my earlier statements, I noted that for me personally, excess return is derived from different levels of information that are available in the marketplace, also from operational and execution excellence, and also risk management. And essentially, these 8 beliefs cover that ground, although the 8th belief is especially focused on OHA as an entity and an investor. So if you look at sort of, I'm just going to sort of highlight the important point of each of these beliefs for your benefit. I can take questions. But the first one talks about the, again, it's information and efficiency of marketplaces, and the idea that over the long term, markets can be very efficient and are driven by sort of fundamental characteristics of strategies and investment opportunities. And again, that's what we expect to happen over the long term, for values to reflect those underlying understanding. And that's a level of information that then becomes available in the marketplace over time. On the second item there, so markets can be very efficient when investors are sort of price takers, when there's a lot of activity and the price discovery process is very transparent. And in those cases, you want to be investing in sort of low-cost passive strategies. Cost becomes a very important consideration when investing in markets that are termed efficient. And again, efficient is because prices are well known and discoverable. On the third investment belief here, we talk about capital markets being inefficient at times, generally in less than full market cycles or when information is not widely available. And in those cases, you want to have very active management where your opportunity set, your investment managers that you work with should be able to derive excess returns and returns that come from doing work, from just making discovery about information in the marketplace and investing in a way to your advantage. And in those cases, you want to be more active in terms of your investments.
Pedro,
yes.
Trustee Souza.
Sure. I just want to kind of nip in the butt before we get to the next numbers. Number one, the section 2.2 long-term objective. It's essentially the same thing, right? What do we, as we implement the number 1 to the general objectives, well, what is the difference to what your recommendation is?
In terms of the investment belief in item 1 and
well,
item
what's
2?
The difference from what we already have in the 2.2 long-term objective?
So the investment belief number one is focused in on the idea that you're a long-term investor. Yeah. And taking advantage, that's like a strength. That's like a superpower. Not all investors can hold on to investments through market cycles, through ups and downs, who have the ability to sell or buy at a convenient time as opposed to being forced because of, you have operational expenses or pensions to pay, and therefore you might have to sell when the market valuation doesn't reflect its true value and underperforms. The second item is focused more on the idea of efficiency in markets. And that's more like the example of the large cap markets in the US, where you have a lot of investors there. You have a lot of price discovery going on through analysis and recommendations by financial advisors. And so in that case, why that's different is that that's just saying that in general, those sorts of markets, as you can identify them, over time, you want to be in sort of more passive and low cost providers. And then the third item is more like active management, right? When do you want to use active management? Right. And again, that's when there's less price discovery going on, or the investors have some additional information or ability to analyze the market differently, and thereby through their active behavior generate returns.
So number three, is it actually at their discretion, or we decide when they're going to be more active, or could something be added in the statement to where we say, okay, this is when it hits this benchmark, whatever it may be, you know, to shift basically at that point. Would that be a...
So there are some of the other investment beliefs that are like focusing on risk management or providing general guidelines, and also articulating what level of risk that you're willing to live with, that you're willing to tolerate, that they say you can sleep at night. Right. Those sorts of policies are kind of directive, but they're not so much timing markets, and they're not so much directing these active managers when to buy and sell securities. It's more kind of, these are the general guidelines. And if you go outside of those guidelines, we need to have a conversation. And if you go beyond even some guidelines that you just can't tolerate, then that could be a grounds for saying terminating or changing the manager, changing the strategy. But once you sort of have identified markets where you believe that experts, financial professionals, are able to generate returns that are worth their fees because they have some additional insight, they have information that maybe aren't available to others, and they're able to execute their strategy better and thereby derive those higher returns, then you want to let them kind of do what they do.
Got it. So once we establish these beliefs, approve these beliefs, right, investment beliefs, we're going to establish the guidelines as to where the parameters, basically. If it is this, then
yeah. Right. So this is only
come back to us.
Yes. So this is only one part of the investment policy statement, and the guidelines and the other things that you're focusing in on are those other parts. So there are things like governance, and then there are, parameters in terms of how much exposure are you willing, what kind of things do you want to invest in, that you should also kind of have a feel. The value of the investment beliefs are really at a almost high level or philosophical level to say, this is what we believe in. Mm-hmm. We believe in passive investing because we think when markets are efficient, we should work with indexes and low cost providers. Mm-hmm. And that's a very strong statement to be able to make when someone asks you, the public, stakeholders, whomever, why do you invest in passive funds? Like, what is the answer? Here's the answer. Please look at our investment beliefs. That's why we have it in the portfolio. But we don't only have passive managers in the portfolio, we also have active managers. So why do you have active managers? Oh, because we don't believe all capital markets are efficient, and we don't believe that low-cost providers can capture active return. And that's why we believe in those markets, like, say, private markets, markets where information is less widely available. You can't just turn on the news and see a report on this is what is going on in private equity, or this is the value of a new company that just started implementing new technology. It's not easy to know what the value of that company is because there's not a lot of information. And so that's why we want a very talented active manager who's probably going to charge us more than those low-cost index funds. But the reason they're doing that is because they're saying we're special. We know something that the market doesn't know. And so you should pay us because we're going to give you a good return. Now, that also gives you a criteria then to say, hey, you're not achieving these long returns that we expected. We need to get, again, another manager here. So these investment beliefs are a way for you to then communicate with your stakeholders, with each other, but then also through time, if you imagine that staff, trustees turn over, and then in future generations, they can look at these investment beliefs and say, why did you invest this way? Oh, you believe this about the markets. And then it'll be up to those future leaders to say, yeah, this still makes sense to us, or we want to go in a different direction. We're going to take this belief out and we believe something else. That's for them to decide, but you're putting your flag in the ground and saying, this is what we believe about the world. This is what we believe about how markets work, and our portfolio reflects that. Remember the analogy I made to the aquarium, right? Sort of, you're trying to invest in the ocean is all your opportunities in the world, but you have to build an aquarium. So you're trying to get the best opportunities that meet whatever outcome you're trying to achieve by recreating the ocean, but in a smaller model. That's essentially what all portfolios are. We would like to get all the best opportunities in the world out there, but what realistically can we get? And what do we believe we can get? Right?
Thank you, Chair. Thanks for joining.
Sure, no problem.
Trustee Galatario.
Some definitions, so there's some clarity. So you have two categories of managers. I'm hearing passive and active. Is that correct?
So on a very general sense, that's
General
right,
sense.
based on information
Right. Okay,
available.
now in the area of active, how many levels of activity do you have? What if we wanted to employ the most aggressive active guy? What does that mean? What kind of information does that person have that the active guy doesn't have? Or let's just go back a second. How many levels of active do you refer to?
So it's a very good question. And it is in fact a spectrum, right? So even within the passive managers, right, which is saying like, you know what, we don't have any special information. We don't know what's going on, but we want exposure to growth. So let's just invest in the S&P 500, for example, because there's some very big index funds, including in your portfolio, that invest in the S&P 500, right? So, okay, but maybe our manager says, well, we can give you the S&P 500, but we know something a little bit more. We can probably give you, 50 basis points in return above what the S&P 500 gives you. And over time, that starts to add up to a lot of money. And as you grow as a portfolio, that's going to grow. Okay, so that's a little bit more active. Maybe we're paying a little bit more for that because they said they're going to achieve it, or maybe we structure it so we pay only when you achieve it. But if you only achieve the S&P 500, then we're going to give you a passive fee.
So if the board wanted to employ the most aggressive play,
yeah,
that's a belief?
That's not necessarily a belief here. This is more just saying that there are levels of information, and depending on the belief you have of whether information is widely spread, you can invest in that. Going back to Trustee Souza, what he was asking about the policies that govern then what you actually invest in. So for example, if there's a highly speculative asset class, in recent years, that has probably been the so-called Bitcoin, right? Is what a lot of individuals maybe are investing in. Maybe there's some institutions that invest in. That's highly aggressive. There's information that's not fully understood because it's a very new asset class. So do you want to invest in that? As an institutional investor, you could invest in that, but that's not what these investment beliefs are saying. These investment beliefs are saying that's an aggressive, that's where maybe active management is going to be what you should be investing in. But that doesn't mean OHA necessarily should invest in something so speculative. That's for the trustees to put into their guidelines and say, look, we do want to invest in more aggressive or more information poor markets. So private equity, venture capital, those are acceptable. But we don't want to speculate on new technology or new ways of doing things. And for us, that would be these cryptocurrencies. We don't know what's going on there, and we think that it's way too volatile. We don't want to experience a 50, 80% drop in our asset values. So that's off limits. That's not where you say that's off limits in your investment beliefs. You're just saying generally you believe that information and fundamental information over the long term drives markets and valuations.
Very simply, 4% increase in a portfolio as opposed to 4% decrease in inflation. What does that do? Cancels everything out.
If you're increasing your returns vis-a-vis inflation, or inflation is dropping, it should be a net inflow and positive for the overall performance. So you should be gaining, return, if that's what you're asking, sort of.
Well, I'm asking if they cancel each other out. If 4% up and inflation 4% down, if it cancels the gain.
So the way to think about inflation, and I'm sorry, I'm gonna maybe get technical and you can stop me, but in inflation, the real issue with inflation is unexpected inflation. So for example, the reason why the Federal Reserve is interested in a kind of like maybe a 2% inflation target. So 2%, that's still 2%. I buy milk every week and it's going to go up 2%. Is that really, what I want? From a macroeconomic policy point of view, if you can predict every year things are going to go up for 2%, that makes it very conducive for business leaders, for consumers to operate in a marketplace where inflation is well understood. But if suddenly we said, hey, we've got a 2% inflation rate, but then it comes in at 5%, that's a big problem, because now I'm paying 5% more and I wasn't budgeting that. I wasn't expecting that. So that's kind of so what I'm trying to say is that inflation is sort of understood as a risk, right? And the risk is that inflation that you don't expect, right? So in terms of managing a portfolio, there are different kinds of risk. Inflation is a big type of risk. And there are strategies, we may actually hear from some strategies today, that are focused on kind of protecting against inflation risk, meaning exactly what you're saying, is that they're going to offset that unexpected inflation, or in fact, they're going to perform well when inflation is going up or going down, whatever the example you gave. So in terms of building a portfolio or generating returns, you do want to have different kinds of strategies that deal with that risk, and whether it exactly offsets it or it performs well when inflation is going up, it's going up. That's what portfolio construction is about, and that's why you own a diversified portfolio. And in fact, the beliefs are conducive to and support what you have, which is a multi-strategy portfolio that you expect to perform well over time. I'm sorry if that was not where you were going.
Trustee Souza.
Thank you, Chair. Vijay, so is number 3 consistent with our current approach, right? Our current model, manager of managers? Would that be the recommendation as far as one of the beliefs with our current model? Because I know we had talked about briefly about the CIO. So yeah, sorry.
So the structure of the portfolio and the way you govern the portfolio, investment beliefs are meant to be more broad. So a lot of different types of portfolio structures, a lot of different types of operational efficiencies can be taken from a beliefs. This is more generally just saying that in the marketplace, there are times when the market is inefficient. So before, when we were saying low cost, get exposure to S&P 500, we're saying those markets are really efficient in terms of information. That this belief is saying that, but some markets are not efficient and some markets are sometimes not efficient. So you want to cover that. And then do you have strategies, managers in the portfolio that do that? Whether it's a manager's approach or an OCIO or other types of approaches, staff-driven approach, that's for you to determine, but determine not in the belief statement. Your belief statement says we believe in manager of managers. No, you can believe that, but not only because of this. This is more broad. Shall I continue? Are there questions? Okay, so looking.
Let's see, wait, Trustee Ahuna.
No, thank you, Chair. I just wanted to just comment a little bit and correct me if I'm wrong. So the reason why we say, well, Joy is saying it's a broad thing is because I think the understanding is we have different investors, different organizations that do our investment, and each of them, they have different portfolios that how they manage it is does certain things so that other organizations can make money off of it. But within those portfolios, they have active managers to passive managers, and I believe the more active it gets, the higher cost. But we have different types of strategies, and portfolios, different organizations, right? Is that what you're saying, Joy?
Yeah, that's correct. So there are different types of managers in your portfolio, and there are different types of managers in the marketplace. And what these beliefs try to account for is why you might want to have them in your portfolio or not, because you have these beliefs of how the markets work.
Yeah, no, because I know it's not for every single investment we make. It's different. That's why it's broad in a sense. But the way they manage their portfolios, they know that they can make a certain amount from their portfolio, and that's what we invest in, right? For each organization, like Common Fund, Goldman Sachs, different investment companies, right?
Yes, they have a bunch of different strategies and funds and that they also support and have in their business, and some of those are in your portfolio. That's
yeah, no, because I just was trying to get back to when we hear manager to manager type of management, it's just that's just how they communicate with us, right? Through us.
Yes, they
yes, okay. And it's happening in different levels, different areas, and everything. I'm just saying this is because I learned about all of this at Common Fund. Of course, they talk to you why some investments are more active, and I just wanted to just make sure that it's different. Some don't even need a lot of management, so it's more long term. So it's different, but there's all kinds of things going on at different levels. I just was trying to make that point. But anyway, no, it was a great conversation, and I like the policy that's in front of us. So thank you.
Thank you, Trustee OHA. I think you clearly learned a lot and probably got a lot out of that conversation.
Trustee Souza.
Oh, sure. Sorry, Vijay. The reason why I asked my questions earlier is because basically this is very broad, right? And some of the things I've been reading and kind of matching up to what we already have is kind of repetitive. So that's the only reason why I asked the question. Like, why is this recommendations coming up now? Because it doesn't seem totally different from how we're already operating. So for me, that's the question I asked. So how is it different?
So investment beliefs aren't necessarily meant to be different than your policy or your portfolio that you have. They're supposed to be a tool to articulate and then communicate and educate why you've built a portfolio a certain way you have, right? So what this is reinforcing and why this is valuable in your investment policy statement kind of at the beginning and sort of as a general statement is it makes very clear to everyone that if you look at the beliefs and how you think the world works, how you think capital markets work, then you should see that reflected in your portfolio.
A lot of this is open to interpretation. I'm reading it. It's kind of like, if I could dive deep into, say, number 2, 6, 7, and 8 looks good to me. I mean, certain parts of that looks good to me. But if I look at the number 5, what does that mean, right? And so,
okay.
So we're not there yet. I'll wait till we get to number 5. But I mean, it's very, very broad. So, like, shining light on this section, is it super important for us to be going over the beliefs right now if we already have stuff implemented already? That for me, I just don't want to waste anybody's time. So that's why I asked the question at the end of the day.
Yeah, so we are going to come back and look at things like governance and specific policy and portfolio structure.
Right.
But before we go and sort of make recommendations about, oh, you should change this, or you should add this, or you should keep that,
right.
We want to make sure we're on the same page in terms of how do you actually think about capital markets? How do you think about the way the world works, right? So, and you can see for these first several beliefs, information is a big part of it, right? And how you believe information is interpreted and spreads in a marketplace. And then do you believe that the different kinds of managers who have these different strategies, like Trustee Ahuna pointed out, can they actually perform? And so if they are, then you are able to say, okay, well, what kind of market is it? Is it an efficient market? Is it inefficient? Are we paying for them to be active? Or do we think, hey, this is that you really just give us exposure to large US stocks or something like that, so you should be more passive, right?
Yeah.
But we're not necessarily making recommendations specifically like, oh, change this, make that, do that.
Okay, okay.
That's why we're doing it.
Thanks, Joy. Mahalo, Chair. Thank you.
Okay.
Trustee Alapa.
Yes, sir.
Hi, Vijay. I'd like to ask about regarding investment beliefs. How is that, is there any way that it's helping to enhance our asset allocations?
So the way to think about asset allocation and your investment beliefs is that the asset allocation, which is a specific exercise that you need to undertake in terms of how you should build your portfolio, what exposures you to have to stocks or bonds or alternatives. Those are different asset classes, right? You want that your asset class exposure doesn't necessarily contradict your beliefs, right? So for example, we talked about investing in speculative assets like cryptocurrency or something like that, right? And the way to think, does that fit in the portfolio or not? Well, how is that a passive investment? Do you just get exposure to it? Well, it's very speculative. Information flow isn't there. It's a new technology, a new information. Maybe not. So if you were to invest in that, then it clearly is on the more active side of the spectrum. But, is it something that you think over time managers can actually capture a return because they have some informational advantage or not? You might exclude it for that reason. And that's kind of reflected in the investment beliefs. So the investment beliefs, again, it's like that aquarium, right? You want your aquarium to reflect the opportunity set that you want to capture in the world, in the ocean, right? So in the capital markets, there's so many different kinds of things you can invest in, but we can't invest in everything. So what do we think and what do we want to invest in, right? So that's where the beliefs become important. And again, you can rely on the beliefs to look at, to point and say, this is why we invest in an S&P 500 index fund. This is why we invest in a venture capital, active, new technology fund, because we have beliefs about what's going on in those markets. In a large cap S&P 500, we think those stocks are pretty well covered in the marketplace. So the value and the price you're getting there is probably reflective of its true value. In a venture capital investment, we're saying, well, those are new companies, technologies that, we don't have as much information on, but they're these managers who have been investing in it for a long time. So they have some skill. They know things that the broad marketplace doesn't know. So if we want to have that in the portfolio, then we need to be in those actively managed GPLP type structures. And that's reflected in the first few belief structures here. Is that helpful, or did I not make the connection?
Well, it's quite extensive, so I'd have to come back and read over what you just said. However, in regards to the asset allocation, I was just trying to
Get a grasp of how this is relevant and how is this going to enhance that particular area of our investment, the asset allocation, that's all.
Yeah, so just looking at the first few belief statements here, they have to do with the kinds of investment that you're making based on how you think the market interprets and reflects value. So I go back to the, if it's a well-covered marketplace that there's a lot of investors, there's a lot of people on Wall Street watching it, information is more widely spread and understood. So probably the price you see in the marketplace over the long term, that's what the first bullet point is talking about, over a full market cycle, reflect the underlying true fundamental value of that. But if it's a marketplace that's less informational rich, then maybe you want to find someone who has an expertise that can get that value for you. And so that would be a more active managed approach. And then that reflects in, okay, we're investing in growth stocks or large cap stocks. We're also going to invest in venture capital. And that's the asset allocation of your portfolio. And then, you do an actual asset allocation study That can be done by staff, with consultants. You can even rely on some of your managers to come in, and then they can give you their different models and say, yeah, you should be 50% in large cap stocks, and you should be 5% in venture capital or something like that.
Yep.
And that's then that's how you're building your portfolio, and that should reflect your tolerance for risk and what have you. So that's what.
Okay, thank you.
Trustee Ahuna.
Yes, I just want to offer up comments for our trustees. So I just wanted to just make people understand that where we come in and where it's very important, in 2008, we learned a lot because, we were meeting quarterly. We should have maybe been meeting a lot more often. And the reason why is because when the 2008 bubble occurred, we lost a lot from our trusts. Then, so learning from those experiences, we came to COVID, and we got the chance to actually meet, and actually we didn't meet quarterly. We actually met with them more often, and that's because a lot of the trustees that were aware that what's happening during COVID, and we wanted to make some changes. So I like that everybody's so I'm trying to understand all of this because it's very important, especially when those times come. And one of the big decisions that we made when COVID happened was not to do anything, because we're so diverse that they believe that we're going to do all right. So I just wanted to just say that, because that's when those types of situations, that's when we got to do our job, and we got to start understanding what to do and with what and where things are, because we can lose a lot. And to me, that's when we have to actually do all the things that we're talking about today. But anyway, thank you. I just wanted to throw that out there.
Oh, thank you. And Trustee Ahuna, that was a very appropriate comment, because also what we're trying to capture in the belief 4 is this idea that sometimes efficiencies persist over some time because of market dislocations. So what you're describing in 2008, 2009, that was a market breakdown, if you will, where it was sort of crisis. It was considered a financial crisis, and even a global financial crisis. And so if that is something that you believe happens often enough in the world, you want a portfolio with certain strategies that are able to balance out that market dislocation. And so there are other strategies, not venture capital, not necessarily growth stocks or S&P 500 stocks, strategy that you can implement in an asset allocation model to be able to either dampen that drawdown or provide positive return, like not negative correlation. It means when markets go up, then or when markets go down, then the value of those strategies go up. So they're performing well when markets go down. So they have a kind of a negative correlation with the general market or with the equity market. So that's what you capture in these kind of persistent crises moments. And so that's another part of the marketplace. Now, some investors, they may not feel like, hey, yes, markets sometimes go down 50%, but we're long-term investors and we don't have to sell any assets, so we can weather that storm. And we don't have to, we can still have more risk stocks than safety stocks or hedging stocks, or strategies, I should say, not stocks. But again, that's sort of what we're reflecting here in this belief statement, which again, we can always adapt or change or leave out, is the idea that sometimes markets not only underperform, but they underperform acutely and for maybe even a significant period of time. And we can have a further discussion about kind of crisis management in terms of portfolios, if you'd like. The fifth belief statement here goes to the idea that as you work with managers and other investors in building your portfolio, everyone has a kind of a business model or a self-interest, and you need to manage that. And so this is more along the lines about how do you actually execute your portfolio strategy? How do you align interests with your, whether it's a manager's approach or it's a, investment manager that you are investing in directly? How do you make sure that everyone is working for the interests of OHA, which is really all that you care about? They can work for their own interests, but OHA needs to also make sure that it's getting a fair deal in the strategy. And so execution risk, that's a source of potential excess returns. And there are different ways to think about kind of how you execute and how you get the best managers, the ones who are able to implement their strategy more efficiently or more effectively than other managers, even in that same strategy. And that's where due diligence and sort of, monitoring of managers and strategies over time is important. And that's something that in other parts of the portfolio, you'll say, well, we want staff to be doing that, or we want, consultants to advise on what that should be. So again, there are different ways you can implement that. The sixth item, belief here, has to do with how kind of markets change over time, and the need to continue to evaluate the risk and return of opportunity sets over time. And that's where you get into the ideas like, do you need to rebalance your portfolio? Again, the actual way that you might do things like rebalance and refocus the opportunity set in front of you, that's something that happens more directly in other policy statements in your overall document. But this says, hey, we do believe that markets change over time because of technology and other factors. And it also notes here, in terms of this belief, that it's important for OHA in terms of monitoring and managing your trust fund to continue to stay current and be educated on that. And that I would include staff as well as trustees in terms of how that's implemented. The seventh item there has to do with kind of risk management, which is a critical component. How do you manage the portfolio in terms of the many types of risk? And how do you think about risk, and how do you define risk for OHA for your portfolio? And a focus on the risk component of returns. Before, we were focusing a lot on returns in terms of efficient information and valuation. But on these 2 points, it's more on the execution, and on this case, in terms of risk management, which really, I think, drives returns. And so returns are kind of a byproduct of taking smart risk, or taking the kind of risk that you want to have in the portfolio. So again, the example of like a cryptocurrency. Oh, wow, they were up 80%. Well, that sounds really good. Who wouldn't want to be up 80%? But they can also go down 80% or more. So, if you just focus on, hey, the returns can be really high, then you might think, hey, that's maybe good for the portfolio. Who can argue with that? But then you say, well, but can you live with the downside and the uncertainty that, you don't even know what the government is doing in terms of regulating? Is it really a security, or is it something else? Then maybe you start to say, well, focusing on those risk factors, maybe it's not appropriate for an institutional investor like OHA. And that's a legitimate position to take. And that's focus on risk is critical to managing an institutional portfolio. The final belief there is one that is focused in on OHA itself and your own mission and your objectives, and what we're trying to capture there. And Kapahana Stacy was very good to provide some of the second half of this belief statement language to make sure it was in line with the overall mission and strategic plan of OHA. So that was really helpful in terms of making this most relevant and pertinent to you as a group. But the idea here is that if for some reason you believe that capital markets are actually negative for the values of Hawaiians, for Hawaiian culture, for Hawaiian values, then why would you invest in it? This statement is saying that you believe that capital markets can provide a positive benefit to the mission of OHA, whether that's the returns or the kinds of investments. You can go in a different directions here. But this statement is kind of saying you exist in terms of your mission. and that mission is above all else. And the reason you are investing in capital markets and a portfolio is because you think that in some ways, having a portfolio invested in the capital markets is beneficial to your mission. And so that ties it in and makes these investment beliefs especially pertinent and relevant to OHA as an entity, as opposed to the other ones were kind of, they're different types of entities that might also adopt some of those beliefs. But this one is especially focused on OHA. So those are the 8 investment beliefs as they're kind of written here. Jerry on my team did a great job of he synthesized and made kind of like a little one statement or a couple words summary of them. And if it's helpful, I can circulate that. But this is what I would recommend be adopted into the section 2 of your investment policy statement as your investment beliefs. And then, of course, we'll come back and talk about other policy recommendations going forward, and ultimately in terms of portfolio construction and asset allocation. So that concludes my comments. I'm happy to take more questions. I know also we have a couple of managers that we would like to hear from. So, Chair, I yield.
Trustee Aquino.
Thank you, Vijoy. I appreciate your presentation as well as the comments that have been made by other trustees. Beliefs are important and they motivate actual behavior. And so this is an important exercise we've gone through. I have to say, however, as a non-financial professional, I don't know how much of the particulars I believe, because I don't know what the complete ramifications of some of the statements are. But on a more general level, I think it would be useful to us to have a set of actual principles that would guide our practice, that go beyond simply beliefs in the status of reality. But here are some principles that we feel are legitimate principles to follow, ethical principles to follow, marketplace valuable principles to follow. And I think that would be helpful. And an example would be number 8, where we have beautiful language. And I'm firmly committed to and believe that everyone sitting on this table, by virtue of our fiduciary duty, is absolutely committed to the welfare of the Native Hawaiian people, the Hawaiian culture, values such as Malama, the Aina, and so forth. And that is who we are. That is why we go forward and invest in the first place. It's a beautiful statement, and it does exist, and it belongs at the front end of who we are. But when it comes to a set of principles or practices or beliefs in the marketplace, I'm not sure how they correlate or translate. How does a noble Hawaiian value, and I don't question that at all, that's why we're here at the table, actually correlate to a marketplace best practice? Let me give you an example of a concern I have, that if this is part of our belief statement about investment. Suppose, for example, we're looking at Kaka'ako Makai, and we have a choice between scenario A, which is to extend the ahupua'a, have fish ponds, have low eat patches, and people living a life that honors the traditions of Hawaii. That's scenario A. We could invest in that. Or scenario B, we could build high rises, we could have commercial activity, but the purpose would be to raise capital to help homeless Hawaiians, to help Hawaiians who don't have residences and so forth. Which one fits our Hawaiian values? Which one fits our mission statement? It's not for our investment managers to have to struggle with that. Our investment managers should have a set of principles and run with those set of principles when we tell them, go invest and build capital for us to do this. The decision as to whether we do scenario A with low E patches or scenario B with commercial property is a decision made before we get to the investment table, if that makes sense. And so, while I don't challenge whatsoever what 8 says, it just kind of illustrates that beliefs don't necessarily translate into best practice principles. And it would be good for us to really come up with a good list of that. I've seen several lists of organizations that focus on the principles by which they will make investment decisions. Do you think there's some opportunity for that to happen in the future as we work this out?
So Trustee, can I be very happy to work with you in terms of principles to present to the other trustees, if you have examples or specific interests like that. But I think you're absolutely correct in that it's not the it's beyond the pay grade, if you will, of your investment managers and your investment portfolio to decide whether you should have a LOE or a commercial generating property for housing. Those are absolutely your fundamental mission and goals that you set as trustees as an organization, and the way the portfolio supports that is doing what the portfolio does, which is to generate returns, but it doesn't have anything to say in terms of what you should be using the portfolio proceeds for. That's your mission and your prerogative, and so that I don't really have anything to say to that other than whatever the board decides in terms of what it is you want to develop or produce, then let's find a way that the portfolio can support that in terms of the way it's able to generate revenue returns and opportunity through that.
And I would like our professional managers to be able to generate those returns that you talk about. I think we do definitely need to have a statement of our values and principles, which we do have, but that is not something personally I think belongs in our investment plan and strategy. The investment plan and strategy should support the decisions that have been already made. We don't want a situation where somebody uses this document and holds us hostage when we're trying to develop something and tells us based on our own document we're going against Hawaiian values. That would be a difficult thing. I think a place to look for being able to come up with some resources is the dialogue that's gone on about ESG over the last few years. While it's got a noble intention, environmental, social, and governance factors in investment, it also has been problematic in actually helping investment managers to make the best marketplace decisions. And that's where you can find a lot of writing and research about this issue and how to balance it. Okay. Thank you.
Trustee Trask.
Thank you. I had wanted to just touch bases with you, Vjoy, and some of the things that we had talked about in our 1-hour training. Because when I look at this, when I look at some of the materials, I have to go back and look at my notes about OHA, because OHA is not like other investors. We're not business. We're not really private sector. But when I consider that OHA is a state sovereign wealth fund, it makes it much easier for me to appreciate that. The reason why I'm raising it is because what I'm looking at in terms of your proposed investment beliefs, I'm very thankful for this, Vjoy, but I keep seeing it through the lens of that discussion because we will never change what we are. And we have to understand that we're a state sovereign wealth fund. So we cannot invest our people's funds as though it were private property. We have to invest it subject to the trust obligation we have. And that means that I really don't have the authority to take risk. I don't have any authority to do that. I need to utilize these beliefs and what we have in terms of the structure in the office to make that kind of a determination. But I'm saying this also because I feel that when I hear Keli'i's concerns, I'm not really, I don't see how that could happen. But the only protection I have is knowing that this board is going through training so we can be more efficient in what we are. And we're a state sovereign wealth fund. We're state. but we're not the ERS. So when I look at the beliefs you're proposing, I'm reading it through the lens of my state trust obligation and no other lens, because I'm an elected official for that purpose. And I just wanted to fly it by you and ask you your opinion about that perspective too. Because when I look at some things, I mean, there's some investments that might be good, but the risk of anything unproven is gonna violate my trust obligation. Yeah.
Yeah, so let me respond if that's all right.
Yeah.
Yeah, I think that's a very good point in terms of focusing again on kind of the risk and what you should invest or not invest in. And that is something that you develop and you are able to articulate through your policy, including statements like what you can invest in or not invest in, talking about speculative versus other types of investments, and define that. And that's something that we should go through with the policy statement and policies going forward.
Yes.
But in terms of being a public entity and being able to invest in different types of risk assets, which is a little bit, I think, what you're implying here. You do have the example of many other public entities that are similarly structured or designed, not exactly like OHA, but along the same lines. And they invest in multi-asset portfolios with different types of strategies and different types of risk that their own boards and their own governance structure has deemed appropriate. And overall, the marketplace also, provides those sorts of opportunities. But if there are certain types of investments that are considered too risky, just from this board's purview, then it's completely acceptable for you to say, well, we're just not going to do any kind of investing in that. If you remember, not that long ago, within our lifetime, even in the early 90s, there were a lot of institutional investors that were not allowed to invest in stocks, or if they did invest in stocks, it used to be the ERS, every quarter, the managers that wanted to buy and sell certain stocks had to come in and present to the board. Oh, this quarter, we're going to sell, IBM, and we're going to buy, this fancy new thing called Microsoft. Yeah, I don't know if that really happened or not, but the process of being able to invest and the concept of what risk is and how portfolios reflect that risk and mitigate those risks has evolved over time. But that isn't to say that it's been solved. There are absolutely investments out there that I would say are not appropriate and too risky for an institution like OHA because of your public mission, because you need to create value and for future generations. But there's no reason to think that over time, something that we deem inappropriate today for the portfolio might be appropriate in a future day. And the example is the way the evolution has gone for institutions investing in stocks and bonds. Whereas at some point, in fact, I know a foundation right now in Washington, D.C. that they still are only allowed to invest in U.S. Treasuries. And so it's hurt their mission over the last several decades as bonds have underperformed stocks.
Joy, can I ask you this? Because I've been trying to look, there's no other entity in the state that is like OHA. And there's none in the US that I can find. Even Alaska Natives are different. But when I look at OHA, and I'm thinking about things like the risk, the way that we manage risk, I wanted to go and take a look at some of the investments of the EUTF and the state ERS. They're not agencies like us, but they do handle state funding, all state program for medical or for retirement. Is this, I'm taking a look at it because I want to see the quasi-state in a way. Is this a good exercise to continue for OHA being a state sovereign wealth fund manager? Because we're not private sector, but when I look at the state, I just see EUTF and ERS for retirement and medical.
So in terms of the exercise of looking at your investment policy statement, looking at your governance policies and documents, I think it's always a worthy exercise. And I think that institutional investors, in fact, in this state, if you move away from those public entities, sometimes tend not to do that for years. So I think it is important for trustees to consider, you know, what's working, what's not working, what's appropriate. That's sort of, I think, the fifth or sixth item here in terms of technology change and the need to continue to monitor a portfolio over time and to stay active and educated about what's going on in the marketplace and opportunities. And also just recall that this particular exercise of adopting investment beliefs is just one small aspect of the overall review of the Native Hawaiian Trust Fund in terms of its policy and structures and governance. And all of that is and performance. And that's all, you know, something that we're working on and we'll be presenting to the trustees in the coming months.
Okay, thank you.
Thank you.
Maybe Joy.
Okay. So however you want to review or go or take a recommendation, that's the recommendation. And you know, however you take it up or the process that you do to adopt anything is what I would recommend either at this point or in the future.
Yeah, we'd have to do it in the future.
Okay.
Maybe through an action item.
Okay.
But thank you, Trustee Aquino.
Just a question on that, our adoption of these set of beliefs for the future. Have we had the opportunity to get a recommendation and a review and recommendation from our administration? I think their input would be very valuable.
Okay.
Or we could refer it to them for that purpose.
Yeah.
Mahalo.
Huh? No, I can talk to him later. No, thank you.
I wasn't asking a question. I was just making a recommendation.
Right.
Thank you.
At this point, would it be appropriate to invite our asset managers to come up and make their presentation?
Oh, yes. But before we do that, is there any testimony on the asset management managers?
No testimony, Chair.
Vijay, yeah, go ahead and call up the.
So the first manager to come up will be PIMCO, and they will go through, introduce themselves and go through the presentation that they've made and answer any questions. Thank you.
Good afternoon.
Thank you for waiting for us.
Will this pick up or should we need to turn this on?
Perfect.
Sure.
Yeah, we can turn on. Before we dive in, how much time should we expect?
How much time? How much time do you want?
20 minutes?
Yeah, that's 20 is good. Yeah, that's
perfect.
That's awesome.
Well, that's what we're ready for. And the conversation that just took place was incredibly enlightening for us to hear some of the dialogue, and we'll try and share some of our beliefs and who we are through this next 20 minutes. And it doesn't sound like there's a very shy group around the table, so please dive in. Again, thank you for the opportunity to be here. My name is Kevin Gray. I've been with PIMCO for 18 years, senior member of the client management team, and have had the privilege of working on the OHA relationship since it started in 2018. To my right is Bill Murphy, a senior vice president and member of our client management team. Together, he and I work across all of our relationships in Hawaii, which I will get to here shortly. And to my left is Andy Mark, Senior Vice President and Credit Strategist, and he focuses on the portfolio that we manage on your behalf, the Tactical Opportunities Fund, which we will refer to as TAC Ops throughout this conversation. The agenda for us is fairly straightforward, brief update / introduction perhaps for some on PIMCO. Again, in the spirit of the dialogue that just took place, who we are and what we believe. Andy will provide an overview of TAC Ops, and then Bill will close with some commentary around some of the resources available to staff and trustees, and this will perhaps hit home with Ramona being in Newport Beach at our headquarters at the moment. But before we dive in, I want to first acknowledge Ryan and other members of the staff who we've had the opportunity to engage with for a number of years and have a very robust dialogue and are frequently in contact, be it email, VC, or in person, which we are here 3, sometimes 4 times a year. And then also VJoy and the team at Consequent, who we've known for quite some time, but through this relationship have had very active dialogue since they joined. So just want to acknowledge them up front. I'm going to turn to slide 5, and I don't know if somebody's controlling the slides for me. Very good. If we could, there, I can see it on there. Slide 5. Oh, there you go. Perfect. In the spirit of who we are the global leader in active fixed income with deep expertise across public and private markets. Full stop. That is PIMCO. Take that away if you take nothing else away from this dialogue. I'm not going to read all the stats on the board, but I'll perhaps color in the lines a little bit for you. We have 22 offices around the globe. Our headquarters is in Newport Beach, California. 1.86, roughly $2 trillion in assets under management. We were founded in 1971, but let me take that a little closer to home for you. We've talked about sovereign wealth funds, not-for-profit endowments. We manage about $100 billion in U.S. pension assets, public pension assets, I should say, including in that sovereign wealth funds across the U.S., $62 billion in nonprofit assets across the U.S. Again, taking that close to home, we manage about $400 million on behalf of entities in the state of Hawaii. You see there that we were founded in 1971. Account 23 at PIMCO is your sister fund, Hawaii ERS. They hired PIMCO in 1978, and we've been fortunate to call them clients since. So it's a very long-standing and great partnership there. Across the bottom, we've provided 3 boxes: public credit, hedge funds, and private strategies, with kind of a box around private strategies. And that's really focused on, that's where the Tactical Opportunities Fund lives within the world of PIMCO. But I would also draw a dotted line to the public credit, because TAC Ops is really a best ideas portfolio at PIMCO that takes advantage of both public credit markets and private credit markets, and it toggles between. It's a bit flexible, it's opportunistic to take advantage of opportunities when we see fit. But these are the statistics, and they're nice and they do mean a lot. But let's turn to the next slide, if you would, to show a little bit more about who we are as an organization, who we are as people. PIMCO has a history of diverse perspectives and giving back, and I think it's important, given your mission, to share some of the ways that we do that as well. I'm going to just hit on 2 topics here, if you will indulge me. The first in the upper right, cultivating a pipeline of diverse talent. We are advocates for bringing diversity into the industry. An example of that, we just closed the application process for our 3rd annual Future Leaders Scholarship. And what that is PIMCO's put $2 million forward. We're handing out roughly 65 $30,000 scholarships to undergrad, MBA, PhD students from underrepresented communities, folks that are interested in finance. There is a no strings attached scholarship here, and we support their efforts to pursue a career in the industry, and we bring them to PIMCO, and we provide some education and hopefully some mentorship and a pathway into a career in finance. The other is bottom left corner, driving impact in our communities. Just some statistics from 2023 that talk about the ways PIMCO gives back. In 2023, 2,500 of our 3,000 employees donated more than 15,000 hours to 150 charities globally. We provided more than approximately $10 million to nonprofit organizations that address hunger, gender equality, and other community issues globally. And this included in 2023 donations to the Maui Strong Foundation following the wildfires through the Hawaii Community Foundation. So that's just a glimpse, and if we were fortunate enough to come back to present more or more frequently in front of this group, we'd be happy to go into a number of the ways that we think we align a lot with the mission that you have here in front of you as trustees of OHA. But let me pause there and see if there are any questions. If not, I'll turn it to Andy to kind of provide an overview of the Tactical Opportunities Fund.
No, thank you very much, Chair. Bill, thanks for being here. What is the amount of assets under management you have for the Hawaii ERS?
Currently a little over $100 million.
Okay, thanks.
Mm-hmm.
I'm just going to say that I'm sure that the trustees here would be interested in that scholarship program in the future, get information so that maybe there's someone from the Native Hawaiian community. Have you had any Native Hawaiians participate in the past?
I don't know is the short answer. We could find that out. But yeah, it's something, it's a newer program 3 years in, but the first year, the applications were frankly almost overwhelming with the number. So we increased the size from 1 million to 2 million and increased the size of the scholarships as well alongside that. So it's been a great program thus far.
That's great. And just to build on Trustee Akina, he asked about ERS, and you said that ERS was the 23rd client of PIMCO going back to 1978.
Right.
And you also have clients as EUTF, and then OHA has been a client since when?
2018. EUTF we've worked with since really close to their founding, and then a number of other entities on the islands as well, as you can imagine. And we're not fortunate to call them all clients, but at different times I think we've called most clients. Great. Let me turn it to Andy to talk about backup.
Let me speak a bit about the fund in which OHA is invested. And of course, I want to reiterate Kevin's comments. You know, we are very grateful for the chance to manage capital on behalf of OHA. And I think I'm happy to share that we've seen that capital grow substantially since the initial investment in 2018. Today, your interest in the fund is about $29 million. And we've seen that grow about $6 million over the 5 years that you've been invested in the fund. So very strong and consistent returns, of which we're personally very proud. The fund is a broad and opportunistic fund, as you heard Kevin describe, and it really taps into what makes PIMCO special in the marketplace. As Kevin alluded to, we're a very large asset manager. And with the size and scale of our organization, what the Tactical Opportunities Fund allows you to do with us is to look across all of the markets in which we're invested and find the best ideas that we see at any given time in those markets. The strategy predominantly invests in credit, which is generally riskier and where the returns are higher than what you'd find in, let's say, government bonds. But where generally speaking, it's a little bit less risky than what you'd find by investing in stocks. These credit markets can include bonds and loans and other credit type instruments. And they can take the form of mortgages, they can take the form of corporate bonds, lending money to small and medium-sized enterprises, and more tangible assets, things like aircraft or things that you could lend against that are hard and that you can touch and feel. The flexibility of the fund is very unique. It can look not just in the public markets where there are actively traded instruments, but it can also look in the private markets. And I think as you heard Vijay and the robustness of the discussion around the values and the beliefs, talks about inefficiency and the ability to take advantage of those. Given the flexibility of the fund and the ability to look across these public and private markets, there are inefficiencies, I should say, that develop between those markets. And the fund has really built the opportunity set, exploiting those on behalf of clients. Things that price a certain way in the public markets may price differently in the private markets. And so we can take advantage of that interplay between those markets to find good returns where we can generate higher returns than you would get if you were invested in a more passive strategy. This is a strategy that's characterized by a high degree of active investing, not only by
investigating and underwriting investments from a very granular level, understanding, let's say, the cash flows of a company, or understanding the unique risks that are posed by investing in mortgages. Sorry, was there a question?
Or should I just sort of?
Okay, that's all right. The fund is broadly open-ended. So, the commitment that you have in the strategy today does offer periodic access to liquidity, but importantly, to go after some of the opportunities that we see in the fund today, you have to have an appropriate match between what we're investing in and the access to the liquidity that we offer to OHA. This is something that we hew very closely to. It allows us a high degree of flexibility, but this is not a strategy where tomorrow you could come and get all of your money out. But that long-term orientation that Vijay alluded to in the beliefs discussion allows you to take that longer lens and be comfortable having capital that's contained in this fund with a protected degree that allows you to then earn higher returns than you could if you were invested in something that you could get your money back relatively quickly. This is a strategy that I think, as we look across the nature of the fund, and page 13, I think we'll kind of underscore one of the opportunities that we see today, which is just the unique nature of how capital is formulated today. Historically, in the markets, banks were big providers of credit. They were the big lenders to anybody who wanted to borrow money. And what we've seen over the last 15 years and where TACOPS has really played is in stepping into the gap that's been left behind by the banks as the nature of how the banking sector provides capital has been changing. Banks have gotten a lot safer, which is a good thing for our global economy and for the U.S. economy. We have seen banks pulling back from certain areas of lending where they were historically dominant in response to regulators. But the demand for borrowing there hasn't disappeared. And this is a strategy that has gone after that opportunity. We know the assets in the credit markets deeply. We have a very flexible fund that today, in aggregate, inclusive of the OHA interest, is a $6.3 billion fund. So it has a high degree of scale to take advantage of opportunities in the market. It zigs when the market zags. It wants to be a buyer of assets when everybody wants to sell. And when everybody wants to buy, we want to be selling some of those things and harvesting the gains that we previously picked up in a different part of the cycle. This is a strategy that I think has served clients exceptionally well. When I think about what makes this fund different, beyond the flexibility and the interplay in those markets, it is the size and scale of our organization. To have a strategy that is truly flexible, you need to be able to look and know deeply the markets in which you invest. With a fund like this and with our teams and the reach into the capital markets that we have, we can find the best opportunities at any given time and feel very comfortable in our ability to understand them and embed them in the fund. The second thing that I think is unique about the strategy is the longevity of the management. This is now a strategy that we've managed very successfully for 11 years. The portfolio management team that oversees it is led by our group CIO, the most senior investment professional at the firm, Dan Iveson, who's invested for more than 30 years, but has a team alongside him in Russ Ganaway and Sharad Bansal, the three of whom have all consistently managed the fund since its launch in 2013. Importantly, this is a fund that's very important to PIMCO as an organization. It's one of our flagship offerings. It's one where we have not only pension clients, but sovereign wealth investors from the U.S., from outside the U.S. that are invested, endowment clients who have something of a similar model to what you tend to see on the sovereign wealth side. And this is a strategy that clients have used to generate higher returns than they can get in the public markets, to tap into inefficiency that exists in those markets and to flexibly allocate capital where the best opportunities are at any given time in the cycle. I'm going to pause there and see if there's any questions on the strategy, the fund itself.
Are there any questions? No one's okay.
Something for me?
Go ahead.
Yeah, Andy, thanks for that. That's very comprehensive. But I just want to make clear. So what you're saying is that bank lending has changed and there are less banks, but PIMCO is not a bank, and you guys are lending to entities that banks used to lend to. And is that appropriate? You have the skill set, you maybe have said that, but is that an appropriate risk to have with your institutional clients? How would you characterize how they use it in their portfolios?
Yeah, it's a great question, Vijay. We do think it's an appropriate risk, to answer the question directly. Banks are generally relatively safe organizations. They have an aversion to losing money, and they have for centuries. A lot of the change in terms of how capital is formed in the economy today is in response to regulators who've made the banks more safe, but in making them more safe, have somewhat curtailed their ability to lend as they might have done in previous years. That's been a trend that is not new. It's taken, now close to a decade and a half since the financial crisis. The banking sector has been made safer, but some of that lending activity has moved away from banks and moved to asset managers like us. We're very thoughtful in terms of how we think about that. We don't want to engage in the risky lending that got banks in trouble like it did in 2007 and 2008. There's a lot of high quality lending that the banks have gotten away from because of that response to regulators. And we think it's a very appropriate risk in this fund. Importantly, a lot of what happens in the banking sector is relatively illiquid. It's not something that you can suitably house in something where you're telling the investors they could get their money out in tomorrow. You'd have to go and sell it, and somebody would want to take a very healthy cut to allow you to sell that. And so a strategy like TAC Ops that has that degree of liquidity protection for the investors is really well suited to go and say to that bank, hey, this portfolio that you own, we would love to buy that from you. The lending activity that you're doing, we would like to tell you what kind of box, what type of borrower we want you to lend to. But if you're willing to agree to that, we'd be happy to take those assets once you've created them, knowing that you can't really hold them within the bank today. If there are no other questions, I'll pass it to my colleague Bill, who'll kind of summarize some of the ways that we can offer value to clients like OHA.
Yeah, thanks, Andy. I just want to highlight, three things that we'd like you to take away regarding the TAC Ops investment. First, with PIMCO, as Kevin mentioned, you are hiring the premier active credit manager. We have a broad platform that operates at scale across both public and private credit markets that gives you access within TAC Ops to the full credit opportunity set. To sort of borrow Vjoy's analogy of the ocean, if the full credit opportunity set is the ocean and you're trying to build an aquarium, PIMCO allows you to go through and pick out the best specimens to populate your aquarium with. And then we also just have deep expertise operating across these markets. So because, we have such experience underwriting, in credit markets, both public and private, we're able to embrace complexity where active management is particularly important and inefficiencies tend to exist and we can add value. As Andy mentioned, over time, since your investment, we've been able to add, by leveraging all of these capabilities, close to $6 million, on top of OHA's original investment. So, while the investment piece is very important, when we look at partnerships, it's much broader than just the investments. So, page 16, please. We define partnerships broadly as, symbiotic relationships that tend to last for a long term and that benefit, both the manager and the entities that we engage with through deep engagement. So I'll just go through the top, this blue bar at the top of the page. These are things that we offer to all of our clients. And we have a long history of working with the plans on the islands, as Kevin mentioned, to deliver these, benefits of partnership. So education, a good example of this, Ramona is at our PIMCO Institute right now. This is a seminar that we host twice a year in Newport Beach, where we teach, trustees, investment staff about fixed income fundamentals, about the fundamentals of building portfolios so that you can better serve, the beneficiaries of the plan. Access, as Kevin mentioned, we are on the island 3 times a year, 4 times a year with senior resources. We are always happy to stop in, give presentations on, whatever topics are, would be of most benefit to you. Analytics, this is something that Ryan has, leaned on many times to kind of leverage our perspectives here. We have a team of 60 plus PhDs and quants that exist only to help our clients solve their most challenging problems. So if ever you wanted to take a look at your asset allocation and see, hey, how could the portfolio benefit from, increasing an allocation to this asset class or excluding that asset class. That is a problem that we can help you take a very, very kind of disciplined look at and, talk through the results with you. Networking. We have client conferences that are great opportunities for you to, meet with other peer allocators. Occasionally we'll bring, folks down to the islands where we can, host a lunch with your allocator peers on the island, give you an opportunity to meet the other folks who are allocating portfolios institutionally. And then finally, insights. We sat and listened to your discussion. PIMCO publishes research that's openly available on many of these topics. Where does it make sense to employ active management? Where does it make sense to employ passive management, given kind of the history of returns and where active management has been able to deliver value? We have macro insights that are published regularly with our, global advisory board, where we employ, folks like Ben Bernanke, the former, chair of the Federal Reserve. So all of these things are, things that we can bring to you. And as Vjoy mentioned, OHA is a very unique entity. All of the sovereign wealth funds that we partner with are unique in their objectives and their asset allocations, but every partnership that we have, the common theme starts with deep engagement, and we can, help you to kind of accomplish your objectives using the resources of PIMCO. So stop there. Happy to talk through any of these in more detail or take any other broader questions you might have.
Are there any other questions? Vjoy.
So thank you for that. Thank you all for that. There was a nice summary of the relationship and how the performance has gone. And then beyond the mandate, what are different ways to work with PIMCO? And so for the trustees that were with us at the Common Fund retreat, we asked Common Fund directly, how can OHA going forward optimize and better use the resources of your organization? And so the same, you've hit on that. But if you could, as a question back to you, is OHA making the best use of you as a manager, as a resource? And are there concrete ways that you would suggest they might consider working with PIMCO going forward? And maybe it's just a reiteration of what you just said, but if there's anything more, I just want to give you that opportunity, because we have asked that of our other managers, and we'll continue to ask that of our service providers.
Yeah, I think it would be reiterating what Bill kind of outlined on slide 16, which is all of these things are available. As mentioned, we work, at least domestically, I believe, with all of the sovereign wealth funds. And if we don't currently, we have over time. And it really, how they access the resources depends on the underlying entity and what they're trying to achieve. Some of them have deep, into the, hundreds of investment staff dedicated. Some have far less. And so how they engage in the resources that they seek out are very different. So I think the best way to answer it would be all of these tools are available to all of you. How you would like to leverage them is really up to you all. We are stand ready to deliver them at any given time.
Trustee Akako.
Thank you. Are you able to share the entities that you represent here in Hawaii? Or how you serve them best?
The public entities we can reference because it is public. I would be less comfortable in a public forum representing those, but happy to discuss separately. I think Ryan and Vjoy are probably very familiar with all of them, and I think all of the names would be names that you would know, but UTF and ERS being the two other public entities, OHA being another, and then there is a healthcare organization, a very large healthcare organization on the islands as well, that we are fortunate to call client among a number of banks and others that we work with. But
I can follow separately on that. But I do want to add that in terms of tools, right, I believe Bill mentioned the asset allocation study. So this is a current project that we're working with PIMCO on to review the current asset allocation and look for various scenarios to improving the portfolio.
Well, if there are no further questions or comments, I want to thank PIMCO for all your service. Thank you for coming down. That was a great presentation.
Thank you. We appreciate the opportunity.
Thank you for having us.
Yeah.
Thank you.
Okay.
Thank you, Chair. And then if it's appropriate, we have one other manager to speak.
State Street. So is there any testimony for the State Street?
Zero testimony, Chair.
Okay, Joy. Oh,
So we'll invite another OHA manager to come and present from State Street Global Partners. Sonia.
okay.
And Sonia, if you want to introduce yourself, and
Sonia.
even though she's only one person versus the three people from before, we won't give her a third of the time. I think up to 20 minutes, maybe.
Right.
20 minutes would be great. Yeah, thank you.
Thank you, Chairman and the board, for having me here today to present SSGA to you. I am Sonia Park. I oversee the Western Region Asset Owner business for State Street Global Advisors, and I'm also responsible for the OHA relationship as well as for some other clients that we work with on the island. Oh, yes, I can. I always talk very quietly. So today, and I want to acknowledge also Ryan and Vjoy, who I have known both of them for a very long time, in having just open dialogue through the course of the year on OHA and its overall investments. And then also just being able to hear today what you talked about in terms of the investment beliefs. It was a very interesting conversation and lots of Q&A. So good things to think about. And I know that Ryan and Vjoy are fully aware of our relationship with OHA and what we do for you. So my goal here today is to bring the board up to speed. I think the last time I was here may have been in 2019. So to bring you up to speed on our relationship. So with that, I am going to have you go to page 3. So when you think about State Street, as a entire enterprise, we have 3 key divisions. And I know that you had a relationship with our investment services division at one point in time for performance and analytics. That is a separate division than the one I am in. And then we have what we call markets and financing, and that is our broker-dealer business. And they do transition management and trading for different clients. And then the one in green is the division that I am in, which is investment management. And that is our sole focus, is investing our clients' money. So we ended the first quarter with 4.3 trillion of assets under management. We are the 4th largest asset manager globally. And when you think about us on page 4, of those, the way that breaks down is just under 3 trillion of that 4.3 trillion is invested for institutional clients such as OHA. And we've been managing assets for the last 45 years. I'm going to skip to page 6. And a couple of key highlights here that I want to point out. Number one, we are the #1 index global equity manager, as well as managing endowment and foundation assets. And then we are also the largest index global and non-US bond manager, and then the 2nd largest US index bond manager, and number 3 for passive or indexed non-US equity management. And those are important points I'll get to when you think about an index provider. You turn to the next page on page 7. So as you think about the 4.3 trillion, we manage money in a variety of ways. The bulk of it is in index investments within fixed income and equity, but we also manage active equity and fixed income. We also have multi-asset class solutions, and then public market alternatives. And I'm mentioning the multi-asset. I will come back to that in some additional comments that I will make later on. So with that, I'm going to turn to page 12. So the overall OHA relationship, I've been on this relationship for the last 12 years since I joined SSGA. The relationship actually predates me, so we've had a very long history with you. You have two CIT investments with us. One is our real asset strategy, which you're currently using as an inflation hedge for the overall portfolio. And then a 1 to 3 year US credit index, and that's an index strategy. And that's used for the enhanced liquidity within your portfolio. So the total assets there that we manage are just under $41 million. And in looking at the last year through the end of March, you can see where your assets started and where they ended. So you started at about 39.8 million, and then you ended at just under 41 million. So that's the appreciation that we've been able to deliver for you on the index funds. And then looking at performance on page 13. So the real asset strategy relative to the benchmark has outperformed over the 10-year period, as well as when you first invested in it, which was May of 2013. And then the US credit index also has matched the benchmark, and you've been invested in that since February of 2017. In addition to those investments, you also have some mutual fund investments with us. And these are mutual funds that were invested in. And so you have broad market exposure through the S&P 500. And then what we call a global all cap. So that's basically everything excluding the US, because you already get that with the S&P 500. And then you have an aggregate bond index. So when you look at these three funds, you're getting very broad market exposure. And similar to peers, this is a very core holding that they also have within their portfolio. It's very liquid, it's indexed. We're not taking active bets. We're just trying to match the index for these strategies. And then looking at page 15. So what I want to point out is looking at the difference of returns, you can see that we're very close in matching what the index benchmark return is for each of these strategies, both for the S&P, the ACWI ex-US IMI, and the ACWI ex-US IMI is short for the All Country World Index, ex the United States, and includes small cap. And then the aggregate bond index similar. So you want to see very small number difference between the mutual fund you're in and the index that is used as a benchmark. So I'm not going to go to another page at this point, but I did want to highlight a couple of things for the way OHA is currently invested in the vehicles that we have. And the first is you have a CIT investment as well as mutual funds. My suggestion is that you move the mutual funds to a CIT. We can have that for a different discussion at a later time, but it's purely a vehicle change. The strategy is exactly the same. And
Can you explain CIT?
Yes, it's a commingled trust fund. So you can't put a ticker in and look it up on Google, but the benefits of a commingled trust fund is that number one, sometimes your pricing can be better because you're an institution. Institutional pricing oftentimes can be lower. Number two, when we trade these, there is the opportunity to do them at zero cost. So for example, if a client wants to redeem out of the same commingled trust fund that you want to invest in, we can cross those units and then we don't have to place any trades in the market. So we think about it from a low cost perspective. So that's the key difference. With mutual funds, you can't do that. And with the mutual funds, you can't negotiate fees. The expense ratio and what the management fee is set and it doesn't change. The second thing is the 1 to 3 year for the enhanced liquidity. And the suggestion there is once you determine your asset allocation with staff and with VJoy, perhaps consider moving that out of the enhanced liquidity and moving that into one of the other broad market indexes, either the S&P or spread it across the three between the equities and the fixed income. So that would be the second thing that I would suggest. But overall, and also keeping the real assets as well. I would continue to recommend keeping that in there, and that's benefited you from the current period with inflation and working as an inflation hedge. So those would be three things that I would recommend as you think about your asset allocation, as you work to adopt your investment beliefs, and what makes the most sense for OHA's portfolio in conjunction with staff and consequent. So with that, I wanted to also talk about our broad relationship that we've had for over 12 years and what other resources are available to you. And number one, we do put out a lot of white papers on different topics. And we also have what we call our official institutions group. That group is based in London. They typically work with non-US sovereign wealth funds. So to the extent you want to be able to speak to some of your peers as being a sovereign wealth fund, I can help to arrange that, and you can have those conversations. I also work with some of the sovereign wealth funds in the US as well as clients. The third is we put together a lot of webinars. We did one today recently on fixed income. We'll do it on a variety of topics, and they're periodic. They're not on a regular cadence, but if that's of interest, we can provide those to Ryan, and he can share that with the board. And they're meant to be educational and to think about what's happening either in the markets from a macro perspective, or to think about it from different investment types of strategies that you might want to think about overall. And then the last thing is, we have a lot of resources, again, as I mentioned, from a research perspective. So as you're thinking about your asset allocation, what you want to do, we're happy to have a conversation through our OCIO team, and that's an outsourced chief investment officer. But because they're looking at a total portfolio for a client, they have some unique views as to what makes sense for endowments, or what makes sense for sovereign wealth funds or for pension plans, because everyone has a different need and you can't just have the same thing for every single pool of assets. So those would be some of the additional resources that are available to you. And I too, as Pinko has said, I do come to the island fairly frequently, but for meeting with clients, it's typically 2 to 3 times a year.
Trustee Galatario.
Thank you. Mahalo for being here.
Thank you.
Appreciate
well.
it. Does the state have any experience with other indigenous entities worldwide? Native American, Indian, Alaskan, Taiwanese, any other similar type of entities? Like Office of Foreign Affairs.
So I would have to check, and I can come back to Ryan with that. The one sovereign wealth fund we do work with that is public is Alaska Permanent.
Okay.
Yeah, we work with them.
Okay, mahalo. Thank you.
Yep.
You had mentioned Alaska Permanent. Can you share a little bit about them and how we're similar?
So Alaska Permanent, it's the revenues from the natural resources that they have, and so they pay their citizens dividends from those revenues that they receive. And so similar type of thing, it's working to invest the money that will ultimately be paid out to the Alaskan people.
Trustee Aquino.
Sonia, I think you may have mentioned this already, and welcome, by the way. What are the assets under management of OHA that you're handling at State Street?
So currently we manage in total, so just about a little over 200 million.
And what would you recommend for additional services by State Street?
So the additional services, and this will be, I'll answer this in a couple of ways. One is, once you determine you're set with the overall asset allocation, how much you want to have in index funds, then that's a conversation that we can have and see if you want to change anything around. When I'm looking at your portfolio, though, you have a very broadly diversified portfolio already with the 3 mutual funds that you have. The second is moving those mutual funds to a commingled trust fund would, I think, be beneficial for OHA. And then the third is around our OCIO, or Outsourced Chief Investment Officer Services, where we can take a look at the whole portfolio and make determination on allocations and manage the portfolio as a whole. We can do that for the whole thing, including public and private markets, or we can just look at the public markets piece of it and determine what that asset allocation should look like. The last thing is just rebalancing. It's really important to rebalance back to your strategic targets. And so that's also a service that we can provide to be able to do the regular rebalancing and making sure you're within your ranges.
Are you providing OCI services here in the islands?
Not on the islands, no, but we are in the States and outside the US. Yes.
Thank you.
Mm-hmm. Are there any other questions? Vijoy.
Can I just add that, so previously, Trustee Alapa had asked about how your S&P 500 exposure was going. And Sonia here in State Street is the person that you can ask that to. And you can see from her presentation, basically, you're getting the return that the broad market is providing. And that's what you should expect, because it is a passive investment that just gives you exposure to certain asset classes or markets, as opposed to the active, where you want to see excess return in terms of justifying the fee. And in fact, the State Street fee is very low. I think it's probably the lowest in the portfolio. So that's kind of how you think of how she and State Street manages these assets. The other point I also want to bring up is, as Sonia has mentioned, the assets that they manage for you, that 200 million, is in a broad class of exposures, from U.S. equities, international equities, fixed income. And in some cases, if your investment beliefs are that we only believe in getting broad exposure and passive investing because we don't think active management justifies, for example, the fees, that would be an investment belief. We would build a portfolio 100% in State Street. And in fact, Steve Edmondson, who's the CIO of the Nevada Public Pension Plan, who spoke in front of you via video a couple sessions ago,
right?
That's their investment belief. And essentially their portfolio is almost 100% passive exposure. I don't know if they only use State Street or State Street at all, but okay, but that would be what Steve and Nevada is doing. So Steve would never adopt the investment beliefs that I presented earlier, because that's not the way Nevada believes the markets work, or at least works for Nevada. So they would have very different sort of a statement, and they would communicate it that way. And he does communicate that way, and they do okay. But that I wanted to add. And my usual question that I ask, Trustee Akaka asked it. So I'm sorry, Trustee Akina just asked that question. And so I think that's great. Thank you.
May I make just...
Go ahead, Sonia.
May I make two more comments? One is to answer your question. Yes, we are one of the managers for State of Nevada. It's public information, so I can say that. The other thing I wanted to mention is it's really important to think about who you're selecting as your index manager. And the reason I say that is the size and scale of that manager is going to be incredibly important. You want someone who's large, in the top 5, because they have a long history of experience as well in managing index investments, and are able to provide these investments at a low cost. Because it's not just about the fees, it's about how the index manager trades the portfolio, the ability to unit cross, as I had mentioned earlier, and thinking about low cost transacting as an ultimate benefit for the client. So there's a lot of different factors to consider when hiring an index manager, not just fees. And then the last comment I want to make is just to say thank you for our very long-standing relationship. We definitely appreciate it, and look forward to the continuation.
Can I just add to her statement there about using a manager? So one reason why you use the passive manager is that low cost, which again was in kind of the investment belief in the first couple investment beliefs. But the other item that Sonia just touched on was, I think it was the investment belief, maybe 5 or 6, about execution and the value that's added by using the right sort of large passive investment manager, that they execute in a very efficient way. And that's why they can keep their costs low and they can be very competitive and generate the returns that you expect from them, which is not, you know, to outperform the S&P 500 by 500 basis point or 10%, but to get to to provide you with that return. And again, it directly reflects the beliefs of what they're doing for you as a mandate, but also how efficient and effective they are in executing that mandate. And so again, it ties back to those investment beliefs that are important to be able to articulate and to understand and be reflected in your portfolio. And that's all I'm going to say on investment beliefs today. Sorry. Thank you.
Thank you. Are there any other comments or questions for Sonia? Okay, well, thank you, Sonia.
Mahalo.
Good to see you again.
Thank you.
That, guys, if there's, yeah, that's the last thing. Can I get a motion to adjourn? So moved by Trustee Souza.
Second.
Seconded by Trustee Akaka. Any discussion on the motion, members? Hearing none. Can I get a roll call vote?
Trustee Ahuna?
Aye.
Trustee Akaka?
Aye.
Trustee Aquina?
Aye.
Trustee Galataria?
Aye.
Trustee Souza?
Aye.
Trustee Trask? And Chair Wahe?
Yes.
6 yes votes.